Hey, everybody, welcome back to another episode of A Millennial's Guide to Real Estate Investing. Today we have a guest from Hawaii. His name's Lane Kawaoka. He started investing in real estate in 2009, and now he manages and co-owns 1,600 units across the country. So we're going to be talking today how he got started, but also how he scaled up then to 1,600 units. So thanks for coming on the show today, and yeah, thanks for being here.
Yeah. Thanks for having me. Thanks for having
Absolutely.
me.
Yeah, so I guess talk a little bit about how you got started, why real estate, and what did your first deal look like in real estate?
Yeah, so my kind of story starts after college. I went to school for engineering and, just like anybody else at the time, like you're told to go to school, study hard, get a good job. So that's what I did and then, save up for a primary residence because that's what you do, right? Like you buy a home
Yeah,
to sort of build wealth, right? Which I don't necessarily agree that's the best thing for most of us in primary markets, but
yeah,
that's what I did. But as a young 20-year-old kid, like I bought that house and I was never home because I was traveling all the time for work, like doing the whole, thinking I was cool flying in first class because I had so many miles, but really I didn't have a life because I was only home on Saturday.
yeah.
So, this house I lived in Seattle at the time, it was like 350,000 was the purchase price. So I did the 20% down. The rent was 2,200 a month, and the mortgage, the PITI was 1,600. So, I didn't know anything back then about like the
Yeah,
50% rule or all that kind of stuff. I just knew like 2,200 minus 1,600, and then it was pretty nice beer money. So I
yeah,
just said, "Oh shoot, this is it! Like I gotta just keep doing this again and again."
yeah. Okay, cool. And then after that, how long did it take you to actually get into investing in cash flowing real estate? And then when did you make that first actual cash flow investment?
Yeah, so that I mean I got good I got started at the right time, right? 2009,
Yeah,
2010. I mean, it was kind of the bottom of the market and even in a primary market like Seattle, you could find those kind of deals all over the place on the MLS. So a couple of years later, I was drinking the Kool-Aid at that point. I
yeah,
wasn't really reading any of the books yet or the forums, but I just kind of realized that I need to save up another 50, 60 grand to go buy another one. So that's what I did. I bought another duplex in Seattle.
okay,
That one was like 250,000 and then the rents were like 2,000. So it
okay.
cash flowed again.
Yeah,
But I mean now those properties you got to buy the first one for like almost
yeah,
$500,000
yeah,
with I mean it's just not going to work in terms of cash flow. But
yeah,
2000 fast forward to 2010 to 13, I was kind of buying another one and then I was like what the heck, right? Like all the prices went up.
yeah,
And then that's kind of the reality that we live in today. Like if you live in Washington, Hawaii, Texas, East Coast, it's just not going to cash flow.
yep. And then so is that so you yeah, so you realized that the your market was not a cash flow market. So then did you start doing your homework then on investing out of state, and did you make the next step was investing out of state, or how did what was next?
Yeah, I mean that's when I kind of realized like, oh shoot, you just can't buy stuff off the MLS, right? Like a dummy and just kind of it's not really turnkey. And then I searched for a few other things like in Seattle, you could go to and buy houses off auction. So I would go to that, and I just realized like, whoa, you need a lot of money to do this. You need to
Yeah,
like take down the whole house, 300,000, 600,000. They didn't have that kind of cash, and
yeah,
you learn about all the burst strategy stuff. And in my opinion, I'm not a huge fan of that because it kind of wastes a lot of time.
yep,
Um,
I agree.
so then I just kept on seeing like people were buying houses in the Midwest for like 100 grand a piece and renting it out for $1,000 and yeah, the appreciation wasn't explosive, but I mean, cash flow was at the end of the day what we're all kind of shooting for.
Yeah,
So that was kind of, I started to pay my attention more towards that.
okay. And do you started just buying turnkey rental properties out of state then, and did you end up selling those houses you had in Seattle to buy those passive properties out of state?
Yeah, I mean, initially I bought a couple of properties just to kind of test it out, and luckily it went pretty well.
Yeah,
First property was like $70,000 purchase price, and it rented for like 800, and it worked, right? Like I mean, like 10% went to repairs, another 15% should go to vacancy and capex reserves, and then the PITI takes out another 400, 450, and then you're
yep,
left with the delta at the end. And I was like, all right, this works. So in 2012 to 2014, I kind of set my sights on selling off those single family homes in Seattle. And at the time, there was a lot of appreciation. So,
Yeah.
did a 1031 exchange where I sold those two properties and I bought nine in that exchange.
Awesome. And then were you still working at that time, even though you had 9 properties, or were you able to live off that cash? Was it enough cash flow for you to live on, or?
No, I mean each of these properties, it's like a mere $300 per property.
Yeah.
So I mean, I only had like 10, and I still worked a day job. I mean, I
Yeah.
think, but the main thing is like the first 5, 10 years of my career, I was kind of working for private entities, so high stress, high pay, right?
Yeah.
So I kind of titrated down to more easier easier jobs where people are kind of a lot cooler, so it's a lot better
Gotcha.
quality of life.
Gotcha. And then what markets were those properties you were buying out of state then?
I started in Birmingham because at the time, this 2013, 14, everybody was kind of going to Memphis, and I felt that was a little overplayed. Um, I don't know. I mean, and Birmingham's pretty much a boring town.
Yeah.
Um, Atlanta and then Indianapolis were my other
Okay.
two markets.
Got
Yeah.
it. All right, cool. And then what was the next step after you got those? So you were still working your day job. You sold the houses in Seattle. Now you had these 9, 10 properties, single family. Were they all single family homes that you had in the Midwest?
Yeah, yeah, yeah. So still working a day job. My goal was kind of to pick up 20 of these, right? Because you're able to get 10 single family homes, Fannie Mae loans in your name, right? And
Yep.
those are kind of the gold standard of loans.
Yep.
And then your spouse can supposedly put another 10 in their name. So that was kind of the operating system I was kind of operating off for a while.
Got it. And then did you max out your 10, and then did you get your wife to do 10 as well?
Yeah, I was gonna max out my 10, but then I got to a point where I realized it wasn't entirely scalable, right?
Because
Because
of
I
the
mean,
financing?
well, because of the pain in the butt, right? Like
Okay.
you get to a point where 10, I mean, don't get me wrong, 10, 20 rentals, it's pretty much it's okay to manage, right? Especially when you have a property manager.
Yeah.
So you're just playing the role of managing the manager, but just from like 10 rentals, that kind of sample size, you're going to have an eviction once or twice a year. You're going to have on a quarterly basis some kind of like stupid thing happen, like someone steals your HVAC,
Yeah.
or this breaks, or there's a few hundred or a couple $1,000 bills here or there
Yeah.
that you got to kind of deal with. At 10 properties, it's fine, but do the math. 10 properties, $300 each is just a, $3,000 a cash flow a month, which
Yeah.
I mean, it's fine, I guess, but like, it's not retirement. It's not what
It
I
wasn't
need like
enough.
$5,000, $10,000,
Yeah.
right?
Yeah. Good point.
So
Okay, cool. And then once you realized that you needed more cash, were you still working your day job? And then did you eventually cash in all those single family homes and upgrade to something bigger? What was the next step after that to get to 10 grand a month?
yeah, I mean, I still think people should get the turnkeys, right? Like, I mean, that's the way you learn by doing it.
Yep.
Um, but definitely don't get like 20 or 30 of them, that's for sure.
Yeah. Yeah, I agree.
So it's kind of this fine line of like how much money do you make at your day job?
Yeah.
Because I think what you're trying to do is you're trying to get your cash flow at the end of the year. That's income at your job minus your expenses, like if you buy, cars or fancy stuff or
Hmm.
dining out, and then add in your passive cash flow. And that's at the end of the day, that's the number that's really important.
Yeah.
And as a household, I think once you get above $30,000 to $50,000 like positive cash flow a year, you're not quite accredited, but like in my opinion, you should be looking to be doing more scalable deals.
Okay.
And those aren't necessarily higher yielding, but at that point, it's usually for more older folks, right? Guys
Yeah.
with kids, families, because I think a lot of, in the beginning, I could spend all day doing this stuff, right?
Yeah.
But as you acquire a life, time is more valuable than money.
Yeah. Yeah, I agree. Yeah, and I think turnkey rentals are a great way for people to start. They can get to see what it's like to be a landlord. And I agree with you. When you have 10 single family homes, you are going to deal with eviction or two a year in the Midwest. There is going to be something that pops up. And you need to account for those things. And that's all part of being a landlord. You can't expect even buying a turnkey that everything is going to go super smoothly the first 3 months or 6 months or 12 months. It's set up where it's going to be the least amount of headache for you, but still, even with a property manager, you have to manage that property management company. And while it doesn't take much of your time, it's still, you are still a landlord, right? So you still have some responsibility to the tenants and making the right decision for those properties to be successful.
Right. But the decisions, they come very slowly at
Yeah,
you. I
yeah.
mean, it's not like you got to make all these things on the fly. I mean, it's just a series of binary decisions,
Yeah.
and it's not like anybody else hasn't done it in the past,
Yeah.
you know.
Yeah. All the answers are online on Bigger Pockets. You can go look them up and they're there. And if it's not, then you can
Yeah.
write it on there and somebody will answer it for you.
Yeah, somebody will answer.
Yeah. All right. So you started with those turnkeys. You got a bunch of them going. And then did you eventually break to multifamily after that when you realized that you wanted to scale it up from $3,000 a month?
Yeah, I mean, looking back, I was on the logical path, right? Like I got some single family homes. I think I'm pretty good at this. And I'm like, all right, well, I'm gonna do apartments, right? Because that's just multiple single family
Yep.
homes.
Yeah.
I got into it, and I paid a lot of money for like a mentorship program, and pretty good mentorship program where you kind of go and you learn how to do this from the pros,
Yeah.
and you get around people who are kind of doing it because I think that's the thing about multifamily. You just can't do it on the free stuff online. I think you're kidding yourself.
Yeah.
You need partners, number one, and a lot of this stuff is like you need to get boots in the ground. You need to like get yourself out of the computer
Yeah.
and like, connect with real people who are doing it.
Got it. And is that
And
what the mentorship kind of taught you, is to that, hey, I can't just research everything online now. I need to actually go find a team first on the ground. Is that part of the training process?
yeah, yeah. I mean, but I went through it for about 18 months, doing everything I was supposed to
Oh,
do,
wow.
connecting with brokers, analyzing like 100, 200 deals in that period. And that's part of it. You learn how to analyze deals,
Yeah.
which is good. But then I was living in Seattle at the time, and there's no deals in Seattle. It's a primary market.
Yeah.
So that was my big disadvantage. I wasn't able to take brokers out to lunch every other month, which I think is imperative.
Yeah.
Um, so
Yeah,
that
me too. I mean, because I'm in Los Angeles, I'm investing in multifamily out of state too. And I look at it too. It's like, damn, if I was in these markets, I'd be flying around or driving around to these different markets and spending a week in each one of them and taking every broker out to lunch and shaking hands and putting them on my email list, etc.
right, you're exactly right, and that's, I mean, just the level of competition. I mean, look around. I mean, you can find about a dozen multifamily gurus telling you should do this stuff and how easy it is, right? Like there's
Yeah.
everybody thinks that they want to be a multifamily operator.
Yep.
That I kind of just did the math and I was like, well, with my net worth, I'm not financially free yet, but on this path I'm going on, I'll be in a pretty damn good place in like 5 years if I
Yeah.
just keep if I'm just a limited partner.
Got it.
So
Oh, a
that's what I
limited
did.
partner. That's what your target was, being an LP instead of the GP?
Well, initially everybody kind of goes in it thinking, yeah, I'm gonna do this, right?
Be
I'm
the
gonna be the guy.
syndicator. Yeah.
Yeah, I'm gonna be the guy doing 150, 200 units. But
Yeah.
then I was like, screw that. I don't want to take these brokers out to lunch, nor do I really want to operate the buildings.
Huh.
I want to just get really good at vetting the deal. So I just switched my focus from finding deals to finding the deal hunters. So I'm the deal hunter.
Gotcha. Oh, wow. Yeah, I haven't heard. I mean, I talked to a lot of beginners who are, or maybe they have a couple turnkeys. They were kind of in your situation when you had those 10 turnkeys, and then now they want to be the syndicator. There's even some beginners who haven't done a real estate deal who still just want to be a syndicator, and that's what their number one objective is. And it's kind of not a natural. I think your process was a very natural progression as well as mine, because I started with single families, then I did 50 single families the last 12 months, and then now I'm getting into multifamily because
Right.
I understand single family, and I think I can understand a 20 unit apartment building. It's the same thing with a little bit more expenses and management, etc.
Yeah.
Um,
And me too. I mean, when I looking to invest in a deal and I vet a deal sponsor, like I want to see that pedigree. I don't want to just see some
yeah,
guy who just did a
exactly.
program, right? Like,
Exactly. Yeah. Yeah, and they
and,
bring
and it's not the same. Like multifamily and single family is not the same. It's kind of a reboot, but the lessons and the character it builds, as corny as it sounds. I mean,
Yeah.
that if I'm gonna put 50 grand with somebody, I want to see that.
Yeah. Yeah, exactly. So is that what you did then? Did you save up 50 grand, or did you sell some turnkeys and you started vetting? Because it took you 18 months to you were in that mentorship program for 18 months learning about multifamily, correct? That's what you said.
Right,
Yeah.
right.
And then did you eventually, after those 18 months, what was that? Did you invest as an LP in a, a syndicator's deal?
Yeah, I mean, at this 12-month period, me and my partner were kind of like, all right, we're not getting anywhere.
Yeah. Yeah.
So we're like, all right, well, we don't have like oogles and oogles of money. So, but we're like, you know what? We're not getting anywhere. We need to buy some properties. We need to get in some deals,
Yeah.
just even as LP. So we can, when we go to these brokers, we don't like they don't care if we did 10 single family homes or 50 single family homes. They could care less. It's completely irrelevant to them,
Yeah.
and it's true, in a way. Like unless you can close a big deal, then these guys don't even want to give you the good deals. So it's very difficult. Like you said, the first deal is the hardest, right? Getting started is the hardest.
Yeah. Absolutely. So then did you and your partner, after the 12 months, from 12 months to 18 months, the last 6 months, is that when then you were like, screw this, let's just like underwrite a bunch of LPs deals, I mean GPs deals and syndicators, and see what they were doing, what their numbers look like, and then pick the best one?
Yeah,
Or...
that was, I mean, that was pretty much it, right?
Yeah.
Like just kind of gave up, right?
Yeah.
But like I always tell people, like begin with the end in mind. Like, what is your goal? If your goal is to own 1,000 units outright by yourself, like, well, you need to change your goal,
Yeah.
especially when you only have one,
Yep.
right? Your goals need to be more realistic. I mean, my goal was like to get to $10,000 passive.
Okay.
It's not crazy, right? It's pretty obtainable.
Yeah.
Why would I need to go into these deals and take all this risk and put down $100,000 of hard money
Yeah.
on a deal to possibly lose it, right?
Yeah.
I mean, yeah, I mean, figure out where you want to be and where mathematically where you're gonna get there, when you're gonna get there, and if that's okay,
Yeah.
then just continue on the path.
Got it. Got it. And then while you're going through this mentorship program, then you and your partner invested in your first deal. Were you still working a full-time job, so you still had that active income coming
Yeah,
in the
yeah. I
door?
mean, I still work the day. I just got home from work.
You still
know?
work the day job today?
Yeah,
Oh my goodness.
dude.
Okay.
I think keeping your job is one of the smartest things you can do if you get paid a pretty good salary, right?
Yeah.
Like,
Yeah.
I mean, if I only made 50 grand a year, yeah, I'd quit my job a long time ago.
Yeah.
But at this point in my career, I mean, it's kind of easy money. And I guess that's why mom and dad sent me to college, right?
Yeah. Good point. Yeah, I mean, I told somebody yesterday who was interested in getting started in real estate investing. He hadn't done a deal yet, but was learning about it, and he was like, "Yeah, I work at UCLA. I'm a whatever there." And if he's working at UCLA, he's getting paid well. And he was like, "I'm thinking about wholesaling and doing all this kind of stuff." And I'm like, "Dude, there's no reason for you to go wholesaling. You have active income figured out. Just keep that day job, and the amount of time it's going to take you to figure out wholesaling, whether it be in LA or doing virtual wholesaling somewhere else, it's going to take you 12 months anyway. So keep your day job and just use that cash to then invest in passive income. So buy turnkeys, be a LP in some big GP's deal, and do it that
Yeah.
way." So that's the advice I gave him too. Very similar to you.
Yeah. And you're going into multifamily too, and I would say like that same analogy you're using, or the same that comparison of like, somebody doing wholesaling and maybe that helps them later in the game. Like it's kind of irrelevant information, right?
Yeah.
Like it's in this that's how single family homes is to apartments. Like that's how sort of irrelevant learning. I mean, it sort of is. You're working with
Yeah.
the same kinds of people, but the networks are different.
Oh, the
It's a
networks.
reboot.
No, yeah, the networks are a
Yeah.
complete reboot. Yeah. Because the
Right.
people who would even invest in I flipped a lot of these houses, and we had investors, and some of those investors who are investing in the single family home deals are even different too. In a multifamily, they may not want to invest in a multifamily deal because it's too long of a hold. Like they love the flip, right? So they want a 6-month
Right.
project instead of a 5-year hold. And it's a way different kind of investment and a lower return too for
Right. I mean, it's like your work buddies and your college buddies. It's like
Yeah.
two different crowds, right?
Yeah.
Like,
So what? Tell me about the first deal that you invested in as an LP. Where was it, and how did you vet the GP?
So that one, I believe it was Oklahoma,
Okay,
like a smaller 160 unit. The sponsor I went with, I how did I find them? I think by joining up with these bigger like mentorship groups, one of the good things is that you get plugged right into the system.
gotcha.
I mean, like it can it's not like one of the free Facebook groups
Yeah,
out there. That's for sure.
yeah.
I mean, so what I would recommend is go to the conferences where you got to spend 500, $1,000.
Okay,
Like I said, you got to pay to play.
yep. And then
And
through one of those conferences, you can meet a GP or meet a couple GPs and get on their list, right? That's what you're
right,
saying.
but that's not the name of the game is not meeting GPs because you're gonna hear the same song and dance, right? What you
Okay,
want to be spending your time on is building relationships with other LPs because the
really?
LPs are the ones who are gonna tell you firsthand,
Oh, the experiences.
right?
Got it. Oh, so you're saying actually network with the people who are investing in the deals, not the GPs, because the GPs are going to say the same damn thing every single
Right.
time. Yeah,
Right. I mean, it's just like turnkeys, right? Like
yeah,
you don't want to go to the providers because they're just gonna say the same damn thing.
yeah.
You want to talk to regular people.
Got it. Okay, cool. And then for that first investment that you made as an LP, did you have to be an accredited investor?
No, no.
You
I
didn't.
mean, the truth is like 97% of syndicated deals out there are for non-accredited investors,
Oh, really?
506 offerings.
506B. Okay, got it.
Yeah, only about the few percent points are 506C accredited only. So it's like people say, "Well, I'm not accredited. I don't see any deals." Well, you're not seeing any deals because you don't know anybody.
Got it. And then
And I,
what was the?
and,
Go ahead.
and I don't know. I mean, in my opinion, if sometimes if you're going to do a 506C deal, it can be like throwing up a Hail Mary from a syndicator's perspective.
Yeah, because you
Because
only have.
you're like crap. I don't have anybody on my list that actually
Yeah,
trusts me.
yeah,
I gotta just throw this out there,
yeah, yeah,
fraud,
yeah. True.
and see what I get back.
So the 506B, you can have you are maxed on the amount of people who can be non-accredited though, right? It's a max of 35 people.
Yeah, yeah, but unless you're doing a mega big deal, you shouldn't really
You should
not.
be fine.
You should be fine. Yeah.
Okay, got it. And then so what was the minimum? Tell me about if you remember like the numbers of that deal or how much you put. Was it a $50,000 investment and the
Yeah, it was a $50,000 investment.
okay, and then
Yeah,
is
I
it
mean most deals are 50
50
minimum.
minimum? Got
Yeah.
it. And then is it like a was it a 5 year hold? Are you still invested in that deal or was it sold off or refied or
Yeah, I'm still in it. I mean, most of the deals I go after are like non-recourse debt. You're putting in $2,000 to $6,000 of rehab per unit.
okay?
So it's sort of like lipstick on a pig.
Yeah,
I mean, I don't like any development deals. I don't really
yeah.
go into development
I
deals.
don't either.
So in that case, most of the deals are, it's pretty cookie cutter. You rehab the units year one, year two, year three, year four, you're absorbing the higher rents, and year
Okay,
five, you're stabilizing the book. So yeah, usually 5-year deals,
okay,
how it typically works. But
got it.
from what I'm seeing these days, it's a little bit harder to get the returns investors are used to because they're a
Yeah,
little spoiled because it's a softer market.
yeah.
I see some deals being pushed out to 6
Oh wow,
just to hit that equity multiplier magic number that people think that they're looking for.
really? Okay. And then so for example, what was the return if you can remember on that first deal compared to what you're seeing now?
I mean, a lot of the apartment deals, right? Like you probably get half of the returns at the end, right? At the refinance or
Yeah.
sale.
Okay.
So it's the cash flow, right? That's the kind of like what you can sort of count on in a way.
Yeah.
And that's the way I look at my portfolio. Like I don't likely a recession is coming up in the next year or a few years, right? Like I don't really care. I'm not really counting on like the end sale
Yeah.
because it's all projections and what they use for the reversion cap rate. It's all a
Yeah.
stab in the dark anyway. I kind of just look at it from a cash flows perspective, right?
Okay.
Like, and it's pretty on par with the turnkeys. Like in turnkeys, you're getting 8 to 15% cash on cash.
Yep.
until you get a $10,000, $15,000 repair bill, of course, right?
Yeah.
But yeah, the syndication is usually about 8% plus or minus a couple points is
Okay.
about the range.
Got it. Without the sale included, just with straight
Yeah,
cash
just
flow?
straight cash flow.
Got it. Is that what you're seeing today, or is that what you're seeing back then 5 years ago?
I think back then, I think a lot of like 2011 to 2014 was kind of the golden era of
Yeah.
apartments. I mean, people like Dallas is for example. I mean, that market just blew up, right?
Yeah.
We talk about a lot of forced appreciation, but that was market appreciation,
Yeah.
right?
Yeah.
Guys weren't even going to the business plan. They're just rehabbing 25% of units and then they double their investors' money, right? And that's just part of it is like market appreciation.
Yeah.
Um, so, past performance is really no indicator of future success.
Yeah, that's for sure. Yeah, because the Dallas market's not going to double again. That's for sure.
Right,
Yeah.
right. That's why I say like when I look at deals, I really want to just scrutinize like the cash flow.
Got it.
That's what I kind of count on, right? I mean, I have the luxury of like kind of being able to wait
Yeah.
a decade. I mean, I still that's why I keep my day job, right?
Yeah.
I want to hold it through the recession.
Got it. Okay. And then when somebody brings you a deal, so you're looking for just the cash flow, you want that to be 8%. Is there do you have like a minimum units that you look for? Or do you look for like what kind of neighborhoods? Tell me about like some other qualifications you have when a
I
deal hits
guess
your
I mean
desk.
high level, right? Like it's half of it's a person, right? Like
Yeah.
I want to know who they are, so I don't really invest with people I don't know, like, or trust.
Yeah.
Because like my first sort of syndication or where I was an LP, I lost like 40 grand.
Oh, wow.
'Cause the guy was just like a shyster, and
Wow.
he was kind of doing like strategic defaults in a way. And if I would have held off a few months and kind of dug up some dirt through some people I knew at the time, then I
Yeah.
wouldn't have invested. But oh well, it
Wow.
happened.
Yeah, yeah.
So that's kind of my one thing. Like I go around, I join different masterminds and go to different conferences so like I can, like I said, meet other LPs
Yeah.
to vet people. And I'll be honest, I'm gonna Google stalk you, right? I'm gonna like LinkedIn, Facebook, I'm gonna use all the means necessary to figure out who you are as a
Yeah.
person.
Yeah.
But that doesn't necessarily mean you have a good deal, right? You just be going for the money grab. So I'm gonna look at the numbers too, as the other half. But
Got it.
what I'm looking for is a story, right? And for me, the story is I just put in my analyzer and I see if the numbers are going to be there, right?
Yeah.
Based on usually it's just like if your rents are like 500 and you're saying it's going to go to 600, is that really true, right? So is your comps there?
Got it.
And then a lot of it is just, numbers, right? It's not like I look only from like 60 units to 150 units. Like I could care less. I care what the bottom of the spreadsheet says, as long as the right assumptions are used.
Yeah. Yeah, and as long as you trust that person, and it doesn't really matter what the deal size is. So
Right.
you do a lot of course, a lot of homework on the GP through certain LPs. You look at the deal and make sure that the numbers make sense in your book, right? So
Right.
rents are not going to go
Right.
from $500 to $1,200. And then do you do any other due diligence about the neighborhood, or do you just kind of is there a certain neighborhood you're looking for? Or is it really just heavily based on the
Well,
GP?
based on obviously you don't want to invest in like a declining population market, right?
it.
Or a bad area.
Yeah.
So that's kind of like checkbox number one. But then based on what market it is, I'm going to use a different rent percentage increase multiplier or escalator,
Okay.
right? Like for Fort Worth, I think we use like 2% on that.
Yeah.
And then I'd say for like slower market like Jackson, Mississippi or something like that,
Uh-huh.
I would use like 1% rent increases per year.
Okay. Got it.
Dallas, for example, I mean, Dallas has had its run up. Some sources are saying it's even like weaker than Fort Worth. I mean, maybe that one I use two and a half maybe. And like I said, like, you get a sense for the analyzer, you see how the numbers work. I mean, numbers don't lie.
Yeah. Yeah, I agree. Yeah, for my market I use 1 or 2%. I even stress test it normally at 0%, and
Yeah.
if rents stay
You're
the
doing what Ohio, right?
I do
So
Cleveland, Ohio, and Memphis, Tennessee.
yeah, yeah, I totally agree with you. You know, one and a half, maybe one
Yeah,
and a half, it's in a better place. But
yeah,
yeah, the I would say the 3% are like maybe a Phoenix or something like that, or like
yeah, or a Nashville or a
yeah, one of those more yuppie-ish
yeah.
places. But like, I mean, see, I don't really underwrite. I don't really know deal like A class or A markets
I
or
don't invest in any.
yeah. I mean, but if you were, maybe you'd use a 3.5, 4%. I don't know. I mean,
But then if you do that, I'm scared over the next 12 months, 24 months, when your value add is completed, or when you say you're going to increase rents, that actually the market softens. There's way too much overdevelopment, and then the rents actually stay the same even after you put the money. Like I'm scared about the market because I think the A class markets are going to get hit pretty hard, in my opinion,
yeah,
when the market does soften or
yeah,
whatever.
yeah. I mean, I just stay in my wheelhouse, right?
Yeah,
Like, I mean, student housing. No, I don't want to sit. I don't even want to look at it.
yeah,
I don't really know it. Or like a hotel to multifamily conversion. I don't know, man.
yeah.
I'm
Too
not
much
even gonna
risk.
touch it,
Yeah,
right? Or I don't know if it's risk. It might be a good deal, but I just don't know,
yeah,
right? But it's good to like, for like guys like you and me, like, if we were to get to the same place physically, we would have these conversations like, oh, what are you using for, this market?
yeah.
I
Yeah,
think
because
those are the invaluable stuff.
because I see from your list of projects, you're in a ton of different markets. So do you go and do your own personal due diligence on those markets? You said like declining population, job growth. Do you go and do your homework, or does the GP typically provide that to you? And since you trust them, you trust their numbers.
I mean, I always like verify it,
Yeah,
right? And it's always like you got to be relative, right? Like a Huntsville is actually a pretty good market these
yeah, I like it.
days. I mean, I would say that one's going to be a lot stronger than Birmingham, right? So things are kind of relative, right? So, and this is where you have a philosophical like argument with the GP and like what is it really should be, right? What are we underwriting it right?
Yeah,
And at
got
the
it.
end of the day, as your role as LP is to verify are those rent comps true, right? I mean, I am personally, I think if you're going to bump the rent increases over 15%, that's just ridiculous. That's not going to happen. You better be modeling like 20, 30% vacancy that first year,
Yeah,
unless it's really under market. But
yeah,
I'm just kind of going off generalities.
yeah. Yeah, because the one I'm buying right now it's like that. So it's the rents are 585. The max is like 600, and then the market rent is 700 to 750. So it is $150 jump in rents, but the place looks like trash. It's C class property in a B class neighborhood, and
Yeah.
it really needs a facelift. Like the landing is falling down, it's all rusted out, and the rust is dripping off the landing, and all this kind of stuff. So there is a like for this one, there really is a true value add, and you can check. There's comps down the street of a apartment building that was just like ours that was renovated, and they're asking like 750, 800 per unit for the same unit size and stuff like that.
Yeah. I,
Yeah,
I think you can definitely get like huge rent increases on single family homes, but I think with multifamily, you sort of create when you're trying to absorb those higher rents, you kind of create your own black hole where like you can't just flood the market with it used to be $600, now it's 800. Like
yeah,
I think that phenomenon kind of happens, and that's why I say like 15%. I think that's a big enough jump that I mean, you just kind of put yourself in the shoes of tenants, right? And you know this, being a single family home investor, and
yeah,
where guys who've never done it don't have a clue of this feeling of like when the tenant gets shown that letter, they're gonna be like, "Screw you, I'm moving."
yeah.
Right? There's a certain threshold, somewhere between 10 and 20%, where they're just gonna balk on you.
Huh. Interesting.
So you need to know that, right? And you need to kind of translate that into like, all right, year one, I'm going to show 20% vacancy. Year two,
Yeah,
I'm going to show 16 or whatever.
yeah, yeah. And that's what we've done, because for the first year we're expecting to some tenants are just going to leave, and so we're expecting like 20. I think it's 20% vacancy for the first year, and then second year it of course slowly starts going up until we're at 90 or percent vacancy or something like that.
Yeah.
Yeah.
But I mean, I think that's one thing. I don't think that really you can get really cutesy with like, oh, it's 17 and then
Yeah.
12 and then 10, but it that really doesn't really move the
It
needle
doesn't
like
make that
some
much of a
other.
difference. Yeah.
Yeah.
Yeah. It's like I'm
Yeah.
not gonna not do a deal because it's 17% instead of 15%, right? So, and there were some things that were happening at the end of closing, like we were asking for credits from the seller, and we would ask the listing agent, hey, we want a credit of $50,000, and then the guy would come back with 25 grand, and then we would kind of look at each other and be like, all right, is it really worth the it's over 25 grand, like is it even worth the extra? Are we not going to do the deal because we don't get the 25 grand? No, we're going to do the damn thing anyways.
Yeah.
Yeah.
Yeah. I mean, I think one good, it's kind of positioning going through the process, right? Like you communicate to the broker and to the seller that, hey, we are engineering our price to this bottom number here. We want to get 100% return in 5 years. All right, this changed. And we're just not pulling this number out of our butts, right? It's like we changed this number here, so this went down to 96%.
Yeah.
So for this number to get up to the 100% in 5 years, we need to change this number on the top of the purchase price, right? And it's like, I don't know, man. I mean, sorry, but it's
Yeah. No, that's a
you
good
know.
point too. Okay, cool. And then, so you just kept investing, and then you were just saving money from your day job and for all the passive income, and just kept on investing in the LP side of things. And did you continue to go and find GPs and through networking and the mentorship or the mastermind groups?
Yeah, I mean, I think once you get in, like, it really is a small world.
Yeah.
So like, once you kind of get in circles and you act kind of with integrity and you
Yeah.
kind of say what you're going to do, I think, and you invest, right? Like that's kind of a big thing.
Yeah. Exactly. Okay, cool. We'll
Yeah.
talk a little bit more about what you're doing now. So you said you're the LP of LPs. So what are you up to now, and are you helping people invest in these LP deals through you, or kind of what's your business now that you're helping other people get started?
Yeah, so I kind of turn my attention to selling off my turnkeys, so I'm like a little over halfway.
Okay.
But then I realized like people they just kind of wanted to copy what I did. So I kind of just tell people what I invest in and they come along and then
Uh-huh.
apparently because I bring some investors into the game, like that adds value, right? Like it
Yeah.
seems like it helps. So that's a part of the general partnership
Got
that
it.
I can get in. And it's been a cool way to like learn from the jump seat of
Yeah.
the airplane.
Yeah.
Like I'm not really the guy who's
Flying.
ramrodding contractors out there, right? Like
Yeah. Yeah.
I'm just in the beginning I was just kind of sitting there, right? Like, oh, this is cool. I don't have to pay for mentorship. I'm kind of in here and I'm learning and I'm
Yeah.
seeing, hey, this happened. This is what they all did. But now it's kind of useful because I like, actually kind of help out and bring value more in terms of like, those are my guys and coach, right?
Yeah.
I
Got it.
think that's kind of neat. So I don't know. I mean, it's been kind of a neat way to kind of learn this too.
Yeah. Yeah, absolutely. Not from the driver's seat, but from, you know, the back seat. You can learn and see what all the guys are doing, and then also help other people get into that same car with you and invest with you in those projects, right?
Right,
Yeah.
right.
Okay, cool. And then what's your 5-year goal? Or do you think you're still going to be doing this in 5-10 years being an LP, or do you want to eventually quit your day job and be a GP? Do you see that happening, or do you like the passive side?
I mean, I don't really want to be the boots on the ground operator.
Yeah.
In my opinion, that's kind of like a day job. Like that's definitely trading time for money,
Yep.
and that's the opposite of where I want to head.
Got it. Okay, cool. So you
But
think,
I think I'd still keep the day job for a little bit longer. I
yeah.
mean, at least till somebody pisses me off or something like that. But I mean, the recession's coming, right?
Yeah.
And I think it would be cool to hold on to that job and
To get you through
just
it.
focus on enjoying life, right?
Yeah.
Like,
Agree. Cool. Is there any way? All right. So, is there any way for people to get in touch with you, or how can they reach out to you?
yeah,
Um,
I mean, yeah, just check out my podcast. I think I think initially I did like the first 20 were like all about turnkeys, but it kind of changed a little bit after that.
Okay.
But yeah, just check, Simple Passive Cash Flow is the podcast. And then, if once you guys take a listen to that, shoot me an email. I'm always kind of okay with helping people out. Lane at simplepassivecashflow.com.
Cool. Awesome. Yeah, thanks for coming on the show and sharing your story. And I think it'll change the mindset of a lot of people, because nobody that I've had on the show yet was, focused on being an LP, right? And kept their day job. So you're a unique story for sure for a lot of people who are listening, who do have a day job and want to invest in real estate, but want to be the GP. That's not always the best option.
Yeah, and I always tell people it's kind of like a subway or a bus, right? Like nobody really stays to the end of the line, right? Only people that do that are kind of weird, I guess, in that sense. But like you gotta have your goals, right? You gotta shoot for your goals and hit it, and if you hit it, you get out, right? Like,
yep, absolutely, agree with you. Thanks for coming on, Lane, and hopefully some of the viewers will keep in touch with you. And if anybody wants to reach out to me, they can reach out to me on Instagram, Martel Antoine. And thanks for coming on again, Lane, and talk to you soon.
Yeah, thanks.
Thank you.